Hello, if you've been watching the Euro Football Championships or the Tokyo Olympics, you'll know that cherry picking the best players can create a powerful team. Now, the same approach is sometimes put to investing, where an investment fund creates a team of strong players, or in this case, fund managers from different companies. Now, in doing so, they bring together a range of skills to serve the end investor. Now, Alliance Trust is one of these types of investment companies. It's a £3.2 billion investment trust which owns shares in companies from around the world. I'm pleased to welcome Craig Baker, who's head of Alliance Trust Investment Committee and Chief Investment Officer for Willis Towers Watson. And that's the company in charge of selecting managers for the trust.
Hi.
So, Craig, the first quarter is quite good for markets, but stocks are finding it a bit harder to press ahead as the year goes on. Where do you see markets going for the rest of 2021?
Yeah, I mean, it's an interesting question because we've seen quite a reversal in what's been driving markets in the first half of 2021 versus what we saw in 2020 and 2019, and to a certain extent 2018, where if you take 2020 in particular, you had the market driven by a very small number of very large mega cap growth companies in the US. Essentially, I think 54% of the return on the S&P 500 in the US was driven by just 5 companies in 2020, to put that in perspective. What you've actually seen in 2021 is that that's broadened out quite significantly. And so it's a much wider group of companies that have been driving the market over that period of time. And the big question going forward is whether that kind of environment will continue, or whether we could go back to the growth-driven markets that we've seen with some of those large technology companies in particular doing particularly well. And of course, the big question there is around inflation. And also the change in the administration in the US with the Biden administration coming in. What does that mean for taxation? What does that mean for antitrust regulations and so on and so forth, and how that could impact the mega cap companies? Our view, for what it's worth, is that we remain positive on equity markets from here, and we think there are pretty balanced forces between the threat of increased inflation and some of the more longer term threats of deflation, like continuing technology improvements, the debts that have built up in the system, and of course demographics. But that's much more asymmetric than it has been for the last 10 years. And so you could see an environment where interest rates increase. And so what we particularly like about the way we structure the Alliance Trust portfolio is that it's very much driven by stock selection. We don't think many people, and certainly not us, are skilled at calling which countries or sectors, or whether interest rates are going to go up or down over the next 12 months. We think stock selection should drive everything, and we're well placed, in our view, regardless of whether we see a shift in what's driving markets over the next 12 months.
So, Alliance Trust has a panel of fund managers, each choosing a number of stocks, rather than just one lead manager running the whole portfolio. What's the benefits of this broader approach?
Yeah, I mean, I think ultimately it could be summed up as it's a much more risk controlled approach to achieving outperformance over the long term. And so you're not reliant on the skills of one individual, or the business dynamics of one asset management organization. And in particular, you don't have a specific style bias. So we can actually put a number of these managers together such that actually it hasn't got a particular style, and it should do relatively well almost regardless of what's driving market. Stock selection will out, and certainly over the long term we think stock selection is the best way to produce good long-term risk adjusted returns. And so we think that's the big advantages to this. Of course, on the flip side, the thing that you might look at multi-manager approach and say, well, is there a danger that it leads to over diversification, so it's difficult to outperform, or indeed that it becomes quite expensive because you've got an extra layer of fees. Actually, we've been quite careful with Alliance Trust to avoid both of those potential pitfalls. Firstly, we get the managers to run very concentrated best ideas portfolios, so maximum of 20 stocks that the managers each run. And we just ask them to pick their best ideas that are going to do well in the long term, worry about kind of risk of permanent loss of capital in the companies they invest in rather than risk in the short term relative to a peer group or a benchmark. We can worry about that in how we blend the managers together. So that addresses the, how you can still outperform quite significantly with a nice diversified set of managers. And then the second piece, because of the fact that Willis Towers Watson has got a lot of scale, we advise on $3.5 trillion of assets. We're able to get very good deals with the managers, the underlying stock pickers in the portfolio, and hence we've been able to keep the OCR on the trust at a very low level, below 65 basis points, 0.65% per annum, which is lower than you get on most single manager approaches, let alone multi-manager approaches that are typically much more expensive.
So, could you give me some examples of how the managers on Alliance Trust panel have made some clever moves in recent years and helped drive performance for the investment trust?
Yeah, absolutely. So it's worth remembering that although at the total portfolio level, Alliance Trust doesn't have a big style bias in the portfolio because of how we've blended the various managers. Each of the individual managers do have some quite strong biases, as you would expect. And so we have some managers that are more traditional kind of value managers. So, in other words, they're starting with looking for cheap companies and then deciding which ones are the highest quality. And so some of those have taken advantage of the market sell-off we saw a while ago to really upgrade the quality in the portfolio. Some companies that became cheap on the back of lots of things being sold off. So in the travel sector, that might have included Booking.com, might have included the likes of Airbus, Transdime. So those kind of companies that have got a lot of reason to believe that they remain very strong despite the sell-off that you saw because of the pandemic. So those were some opportunities that those kind of managers looked at. And then with more of the growth-oriented managers, they were already quite well positioned by owning a number of dominant companies with great growth prospects. What they did quite well is that they were prepared to carry on owning a number of those where lots of other investors were doubting whether that long runway of growth could be continued. So examples might be Visa or Autodesk. And then there are also some other managers that were looking more for long-term growth stories in markets that have been specifically disrupted by COVID. So HDFC Bank in India might be an example where it's been growing solidly for decades by rolling out banking in to an underbanked population and taking share from inefficient banks elsewhere. But that sold off quite a lot as India generally sold off on the back of some of the pandemic issues that were going on. So that actually gave an opportunity to increase weighting to those kind of companies as well. So depending on the type of company you're looking at in the lineup, there were lots of opportunities that each of them saw that came from the market dynamics over the last couple of years.